Hello, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia. And today we're digging into one of the most time tested, dependable strategies in investing. We're talking about dividend investing. If you're looking to generate stable, long term income, whether you're planning for retirement, want to supplement your regular earnings, or just prefer a more reliable return over high risk, high volatility bets, then this episode is for you. In a world of unpredictable price swings and economic noise, dividend investing continues to stand out as a smart, measured approach to wealth building. Let's get into why that is and how you can build a dividend-focused portfolio for 2025 that stands the test of time. Why dividends appeal to income-focused investors? First, let's break down the basics. What are dividends and why do they matter? Dividends are regular payments made by companies to shareholders, typically drawn from their profits. Unlike growth stocks, where your return depends on the share price increasing over time, dividend stocks reward you in real cash, often quarterly. For conservative investors and retirees who want to live off their portfolio without constantly selling shares, this steady cash flow is a game changer. But it's not just about getting paid. Dividends offer a few key benefits. Passive income, this is the core appeal. Dividends pay you while you hold your shares, so you don't have to sell assets to meet your income goals. You're building wealth while earning cash without touching your principal. Compound growth. Reinvest those dividends and you'll accelerate portfolio growth. This is where long-term compounding kicks in, especially if you hold high-quality dividend growers. Lower volatility. Dividend-paying companies are typically stable, mature businesses. These are firms with reliable earnings, and they tend to hold up better when markets get rough. Inflation protection. Companies that increase their dividends over time can help protect your purchasing power. That's critical in today's inflation-sensitive environment. How to analyze dividend stocks. Now, if you're thinking of diving into dividend investing, you need to know how to separate the solid payers from the shaky ones. So let's walk through the key metrics and filters to use. Dividend yield. This is the annual dividend divided by the current share price. So if a stock pays $4 a year and it's trading at $100, the yield is 4%. A good yield range for sustainable income is usually between 3% and 6%. Anything much higher, say 8% or more, should raise eyebrows. That could be a sign of a distressed business or a company that's overstretching its payout. Payout ratio. This tells you what percentage of earnings the company is paying out in dividends. For most industries, a payout ratio below 60% is a positive sign. It means the dividend is supported by earnings, with room for reinvestment and growth. Now, for REITs or utilities, the payout ratio can be higher due to their structure, but still, watch for consistency and sustainability. Dividend growth history. You want to see consistency here. A 10-year or longer track record of dividend increases is ideal. That tells you the company isn't just paying out of habit, it's growing its earnings and rewarding shareholders year after year. That kind of consistency is gold in a dividend portfolio. Free cash flow. A company can't pay dividends unless it generates real cash. Free cash flow, cash left after capital expenditures, is a crucial indicator. If that number is strong and growing, the dividend is probably safe. Debt to equity ratio. Too much debt can crush a dividend during tough times. Stick with companies that manage their leverage carefully. Look for conservative debt loads and solid interest coverage ratios. Economic moat and stability. You want businesses that have a strong competitive advantage, like brand power, cost leadership, or regulatory protection. Think consumer staples, utilities, healthcare, sectors that perform in any economy. Combine all of these, and you've got a solid fundamental approach to dividend stock selection. Technical analysis for entry points. Now, I know dividend investing is mostly about fundamentals, but that doesn't mean you should ignore technical analysis. If you're just learning technical analysis for beginners, here are a few tools that can help you identify smarter buy points, especially in volatile markets. Support and resistance levels. Look for zones where the stock has previously found support. Buy near these levels can give you a better margin of safety. Moving averages. Keep an eye on the 50-day and 200-day moving averages. Stocks trading above both tend to be in bullish trends. That's good confirmation for a buy. RSI, Relative Strength Index, this momentum indicator, can tell you when a stock is oversold. An RSI below 30 might mean a bounce is coming. Volume trends. Volume spikes on price movement can confirm whether a breakout is real or likely to fizzle out. Even if you're a long-term investor, getting in at a good price is never a bad idea. Global diversification for dividend stability. Let's take it one step further. Don't just look locally. Dividend investing works even better when you diversify globally. That means holding income-producing stocks across multiple countries, sectors, and currencies. Some great examples of global dividend pairs. Nestlé, based in Switzerland, is a global leader in consumer goods with a long dividend history. Unilever, headquartered in the UK and Netherlands, provides consistent dividends and big exposure to emerging markets. Royal Dutch Shell offers income and energy sector exposure on an international scale. So why go global? Because global diversification helps reduce geographic risk and gives you exposure to growing economies. Plus, it can help you capture higher yields or better dividend growth than you'd get by staying domestic. Just keep a few things in mind. Tax treaties. Some countries withhold taxes on dividends. Check whether your home country has tax treaties to reduce this. Currency risk. Fluctuations in exchange rates can impact your returns. Some global ETFs offer currency-hedged versions. Different cycles. Not every country's economy moves in sync. That can work to your advantage if one region's in a slowdown while another's booming. Pitfalls to avoid. Now let's talk mistakes. Here are the most common traps dividend investors fall into. Chasing high yields. If it looks too good to be true, it probably is. Be cautious of stocks yielding over 8%, especially if earnings or cash flow don't back it up. Focusing only on income, don't ignore total return. If your stock drops 20%, that 5% dividend won't feel so satisfying. Overconcentration. Don't load up on just REITs or just utilities. Spread your bets across sectors and geographies. Neglecting inflation. A flat dividend might not cut it. Look for dividend growers that outpace inflation over time. Skipping reinvestment, consider setting up a DRIP, a dividend reinvestment plan, especially in a tax-advantaged account. This can accelerate compounding. Forgetting tax treatment, dividends are often taxed differently than capital gains. Holding dividend stocks in IRAs or ISAs can minimize the tax bite. A realistic dividend portfolio for 2025. Here's what a balanced dividend portfolio might look like. Dividend aristocrats, companies that VE raise payouts for 25 plus years, like Procter & Gamble or Johnson & Johnson. High yield picks from REITs or utilities for stronger income today. Global dividend ETFs for geographic diversification without the research overhead. Blue chip staples like Coca-Cola or Pepsi for a combination of safety and moderate growth. Diversify across these, and you've got a strong mix of yield, stability, and growth potential. How to get started. If you're new to dividend investing and not sure where to begin, check out crystalballmarkets.com. Their platform is built with beginners in mind, offering educational content, clear tools, and user-friendly interfaces. Whether you want to trade individual stocks or explore ETFs, it's a great place to build your first dividend portfolio. And don't forget, we dive into all of this and more on the Crystal Ball Markets Investing Podcast. From stock picking strategies to analyzing dividend-paying companies and comparing value versus growth investing, we've got content that fits wherever you are on your investing journey. Final thoughts. Dividend investing isn't sexy, but it's smart. You're not chasing hype. You're building real, repeatable income that supports your life and your financial goals. Understand the fundamentals. Use technical tools to time your entries. Reinvest wisely. And most importantly, diversify across industries, countries, and asset types. If you're patient and disciplined, dividend investing will reward you over time. Steady cash flow, wealth compounding, and long-term peace of mind. That's what this strategy is all about. Thanks for tuning in to Financial Market Insights for Traders. I'm your host, Sophia. Until next time, invest smart, stay focused, and remember, Slow and steady wins in the long run.